So I did a video last week analyzing Redfin more in depth. Today I will analyze Zillow, their company and their financials, and later on I will show you guys my expectations of growth for both companies, compare their financials and their performance. And as always, at the end of the video I will give you guys my opinion on which stock I prefer to invest on and why. I will put timestamps down below, and please smash that like button and subscribe since it really helps my channel out. First, remember you can get 2 free stocks just by signing up with Webull and depositing $100. The link for that one is the first one in the description below. So let's start. I know most of you have used Zillow website and might already know what they offer in it, since Zillow is a leading company in the real estate and rental marketplace, which provides tons of data in their website and mobile app about houses that are for sale or renting, and also lets people sell their own houses through their website. They have 3 different sources of income. The first one is called Homes. This is a segment that is practically new since it was added in 2018 to their product portfolio. In the home segment, they generate revenue by buying and selling houses through a program called Zillow Offers. Zillow Offers are mainly used when someone wants to sell their house fast without going through the hassle of real estate agents, open houses, and tons of showings. Zillow sends you a cash offers and goes from there without repairing anything, showing the house, and more. So because of this, Zillow is a company that owns and sells real estate. From a customer perspective, I would imagine that you will not get as nearly as good money if you sell your house to Zillow or any other similar company, but you will avoid the realtor fees and the hassle of selling or buying a house. Then they have the segment called IMT, in which they sell advertising services and their marketing software plus technology solutions for any real estate business or professionals. The last segment is their mortgage segment, in which obviously they sell advertising services to mortgage lenders and mortgage professionals, plus also have Zillow Home Loans, in which they originate mortgages and refinance people's houses when asked. In other words, Zillow is not only a website for people interested in real estate, but it's also a tech company and advertising company that collects tons of data that lets real estate agents, property managers, landlords, lenders, builders, and brand advertisers to advertise their properties or services and target a huge audience. They reported a Q2 earnings on August 6th, and they're supposed to report Q3 earnings on the 4th of November. As I said, their revenue is divided in 3. Their home segment, the IMT segment, and the mortgage segment. They reported a revenue growth of 82% on their home segments in comparison to the same quarter last year, then a decrease of more than 13% year over year on their IMT, or their internet media and technology segment. But the reason IMT income declined was because apparently Zillow offered a 50% discount to all their partners, which are realtors, mortgage loan officers, and more, during COVID. And this actually was an excellent choice because that helped them maintain all their paying customers during the pandemic, and that number, in my opinion, should come back up before the year ends. The last segment in the revenue is mortgages, which had a growth of 25% year over year. It was a very nice jump year over year, and mostly in their home segment. The thing here is that their expenses are really high. It cost them $431 million to be able to generate $454 million in their home segment, and it is a number that grows even more when their revenue grows, meaning that maybe if they lower those expenses, that revenue would not grow as much. As you can see, their home's expenses grew 79% while their revenue increased 82%. Their IMT costs are way better. They only spent $23 million to generate $280 million. We are talking about a 91% margin right here. Lastly, for their mortgages, they have a cost of 17% of their revenue, which is also very good for the company. The only one that is really high, in my opinion, is their home segment, but I do know that buying and selling houses might not have the best margin for anyone. Still, it is a segment that has grown exponentially since it was added. If they are able to continue with this type of growth in their homes business and be able to improve those margins, then it would get really interesting. Another thing I noticed here is that even though their total revenue grew 28% year over year, their losses also grew 17% year over year. That is why you can not only get away with an excellent revenue growth of 28% if their losses are also increasing 17%. Now their balance sheet. They have a total of $3.5 billion in cash and cash equivalents and short-term investments that have grown 87% since December 2019. They have total current assets of $3.9 billion and total current liabilities of $387 million, which have actually decreased a lot since December, mainly because of the decrease in their borrowings on their credit facilities, which are a type of a loan. If we calculate their current ratio by dividing their total current assets by their total current liabilities, we get a 10.07, which is incredible. Now, they reported total assets of $6.45 billion and total liabilities of $2.4 billion. If we calculate the total liability to asset ratio, we get 0.376, meaning that they have 37.6% of their assets financed with debt. I do want to mention here that they have more than $1.9 billion in goodwill, and I do not like to take that number into consideration, but still, without that amount, their total liabilities to asset ratio is impressive for this type of company. Now, let's compare Zillow with Redfin. Zillow makes it easier for customers to buy, sell, rent, and finance residential real estate. Redfin also focuses on helping people to buy, sell, or refinance their real estate. The difference is that Redfin is a residential real estate broker which has their own agents to represent their clients and just charge between 1 to 1.5% for their service. On the other hand, Zillow is more of a database website. Also, both companies are buying and selling houses, and both companies also offer finance services. I did several spreadsheets here to compare their financials really quick, and then other spreadsheets to show you guys my analysis and forecast for both companies. So Redfin has a market cap of $5.82 billion, while Zillow $22.9 billion. Zillow current stock price is $101 per share, while Redfin is $54.56 per share. Their performance since March has been huge for both companies. Since March 18th, Zillow is up 303%, while Redfin 428%. Obviously, Redfin return is way better than Zillow, but both companies have had an excellent performance. Now, their income statement. Zillow revenues grew 28% in comparison to the same quarter last year, while Redfin growth was only 8%. But the most important thing is that Zillow loss actually increased 17.3%, while Redfin loss decreased or improved a whopping 46.7% year over year. So yes, Zillow revenue growth has been more impressive than Redfin's, but it was only possible because apparently their expenses and cost of revenue increased since Redfin's losses has actually improved quite a lot. And lastly, their balance sheet. I do have to say that both companies have excellent and very healthy balance sheet as of last quarter, but one is healthier or better than the other one. As you can see, Zillow has a higher current ratio and a lower total debt to asset ratio than Redfin. Again, both companies are excellent managed. It is just that Zillow is a little bit better in this section. So if we were to evaluate these two companies depending on these metrics that I created to compare them, Zillow will be the winner since they had a way better revenue growth and way better current ratio and total debt to asset ratio, while Redfin had a better stock performance and excellent loss improvement. But now let's check both companies on a yearly basis, give my expectations and my final decision. Let's start with Redfin, taking into consideration that the numbers for 2020 are my estimates since I only know the results for quarter 1 and quarter 2, so I estimated the other 2 quarters taking into consideration their last year's performance. Last year they reported a revenue of $779 million and a loss of $80 million. For this year, let me show you guys what I did. For the revenue, I added up the 2 first quarters plus estimated a revenue growth of 50% to 70% quarter over quarter for quarter 3 and quarter 4. That gave me a revenue growth of 3.7% for the service segment and 80% growth in their product segment year over year. I do have to say that that is a conservative growth for that segment since previous years they have had reported a growth as high of 400% for the product segment, but we have to take into consideration that we are in a pandemic and that they had to stop that side of their business for 4 months. I estimated their expenses as well, and according to my calculations, they could have a loss of $47 million this year if they are able to manage their expenses and decrease the unnecessary ones as they have been doing. Obviously, a $47 million loss would be a huge improvement since last year they reported a loss of $80 million. Now, after doing these calculations, I wanted to estimate their growth from now to 2025. So I estimated them to have a revenue growth of 5 to 7% on their service segment year over year for the next 5 years. Then an estimated growth of 50% for our product segment, which let me tell you that is very, very conservative since we have seen more than 300% increase on a yearly basis. But I'm thinking that growth could stabilize or maybe have a bad year if real estate market slows down in any of the coming 5 years. So I'm estimating a revenue of $4 billion by 2025. Now, as the company is going to continue growing and improving, I do expect them to be able to lower their cost of revenues in order to get up to profitability. Right now, their cost of revenue for the service sector is around 66%, and the cost of revenue for the product segment is actually over 100%, meaning that it is not a profitable segment. So for 2025, I expect their service cost to drop to 60% from 66%, and their cost from the product segment to drop to 94%, which is what other companies like Zillow have in this sector. Here you can see their tech and development, marketing and general and admin expenses, which will obviously increase while their revenue increases, but at a very healthy pace. So by 2025, I do expect the company to be profitable and report a net income of $130 million according to my calculations and estimates. So with that, I was able to calculate the expected stock price by 2025. But first, let me explain that both Zillow and Redfin are very difficult companies to evaluate, mainly because people see them as tech companies, but also as real estate companies. I like to see them as tech companies, but I did both estimates just in case. So if they reported a net income of $130 million and have total shares outstanding of 99,480,000, which is what they have right now, they would have an earnings per share of $1.31 per share. Now, the average PE ratio for a real estate company is to trade between 35 to 45 forward earnings. So if we analyze this company as a real estate company, then their expected stock price by 2025 would be $45 per share, meaning that it is currently overvalued. Now, as a tech company, it is common for a growth tech company to have a PE ratio between 100 and 200, just like Amazon or AMD, and some others even higher. So if we estimate the stock price as a tech company, their price for 2025 should be around $130 per share. Now, Zillow. Last year, they reported a revenue of $2.7 billion and a net loss of $305 million. I did these estimates just like with Redfin, taking into consideration past year's performances. For the home sector, I'm estimating a growth of 30% year over year. Then for the IMT sector, which is their internet, media, and technology segment, a growth of 10%. And for the mortgages segment, a growth of 18%, mainly because of low interest rates, since more and more people are refinancing their houses or taking new mortgages for new houses. That gives us a total of $3.3 billion in revenue, which is a growth of 20% year over year. Now, they have lower cost of revenue for the home sector in comparison to Redfin. So for this year, I calculate a 96% cost for homes, 10% cost for IMT sector, and 18% cost for the mortgage segment, which is an average of their past performances. After all these expenses, I'm estimating that they will report a loss of $284 million. Now, I am expecting their revenue to grow like this. Their home segment to increase on average 20% year over year. As I said with Redfin, they could have a way better return in the segment since it is a high growth segment, but I'm taking into consideration a possible bad performance during 1 year because of any slowdown on the real estate market. On the IMT segment, I expect an average growth of 8 to 10% year over year. And lastly, their mortgage segment, I expect an average growth of 8 to 10% as well, which gets us a total revenue of $6.65 billion. Now, take into consideration that from 2017 to 2018, they reported a revenue growth of 20 to 30%, while from 2018 to 2019, they had a revenue growth of more than 100%, mainly because of the home segment that was added to their portfolio in 2018, but saw huge growth starting in 2019. By 2025, I expect them to have a net income of $3.7 billion, which in my opinion seems very bullish to be honest, but it is possible if they are able to manage their costs and expenses. Now, Zillow tends to dilute their shares on an average rate of between 3 to 4% year over year, so to calculate their expected stock price, I'm taking that dilution into consideration. So by 2025, I expect them to have an earnings per share of $13.32 per share, which with a real estate PE ratio of 35, it gives us a stock price of 466, but with a tech PE ratio of 50, lower than Redfin since Zillow seems a more mature company, I got an expected stock price of $666. I do want to say that I'm not a financial advisor and these are all expectations, but after this analysis, I would definitely prefer to invest in Zillow according to the calculations, but have to take into consideration that in 5 years, a lot of things can happen. Redfin could come with a new product or service that could help them boost even more their revenue and surpass Zillow growth. I do want to say that I like to invest in two companies from the same industry to have way more exposure to this industry. And right now I would like to start investing in Zillow and maybe a very small position in Redfin next month or before year ends to track the stock. Let me know in the comment section below if you like this type of videos, this type of analysis video, and also if you have ever invested in Zillow or Redfin. Hope you enjoyed the video. Please smash that like button and subscribe since it really helps my channel out. Thank you and see you next time.